Hello, agents. Hello, everyone. So a lot's happened since Friday with the Silicon Valley Bank going down and everything like that. And really, we've seen the 10-year treasuries just tank. And actually, all the treasuries have been going down. So let's take a look at how the 10-year treasury being down and how will MYGA companies react, or what do we expect maybe to see going forward. So let's just take a look at overall at the my presentation here. So as you can see, in July of 2022, rates began to rise, and we saw that from this 2.68% here in July to where it went up to 4.22% in October, and that's where we saw interest rates really take off, especially in the short-term MYGA rates, breaching the 5% and well into the 5% range. And then we did see a dip come in December of 2022 on the longer term stuff. The shorter term stuff actually, as you can see here, kind of took off. So that made the shorter term MYGAs, the 3, the 5, the 7 year increase. But really the 3, the 5, the 3, 4, and 5 really increased. And you saw the 5 and the 5 to 10 years actually decrease during this period of time. Then again, we had a rate increase in March 2nd, and actually the 1 year went up so high that they relaunched 1 year MYGA rate, right? We actually had a 1 year fixed annuity come out, which has been quite a while since we had one of those. And then just in the last, 11 more days, we see what's going on today. So that 1 year really tanked out, as you can see, and so did the 5 and the 10 year. So everything's gone down. So will rates drop? More than likely, you'll see those shorter term rates really decline come to April, unless we see these rates readjust, and maybe even before, because that 1 year here, this green line really took a dive, and we'll look at that a little bit more in a second. So remember now, currently we still have that 5.45 for 10 years, which will guarantee a 70% gain, assuming you don't take any money out for the 10 years. So that's a smooth and level, assuming no withdrawals. And as you can see, each year it compounds and grows until you hit 70% after the 10 year. But let's say interest rates decline by 45 basis points, and that drops to a 5% rate. That 70 now drops to 62%. And how does that equate to actual dollars? Well, that's going to turn that $500,000. You're going to, instead of making it $850, it's going to grow to much less, $35,000 less, simply by that rate dropping 45 basis points. So keep that in mind if it goes down even more. So right now you can lock in 70. If you wait till they drop it, which we assume they probably will, we don't know. Of course, rates are subject to change at any time. As of right now, we have no notification of that, but it would drop it, say it to 5. You could lose, 8.1, 7.1% on that. So it'll drop from 70 to 62% gain. Still not bad. It's still all guaranteed, but it's really nice to know where you at right now and what the future may hold. And of course, we never really know what's going to happen. So again, here's just an illustration on that 5.4. I really like it. And what you need to look here, there's your gain guaranteed. And you see it's a walk away after the 10th year. But what we want to know is these minimum guarantees, which is the strongest guarantee in the contract, is likely to drop too, as those short-term rates drop and other rates drop. Because these minimum guarantees are based tied to these certain indexes and certain key interest rates. So currently, you get 5.45 on this product for 10 years, and it never less than 250 liquid after that. So that's very strong, that 250. We'll have to see where they go with the current interest rate drops going forward. So if you need a deferred illustration, go ahead and click on the deferred illustration button. It'll pop up a little quote request form. If you do it right, I'll pop up that window. And, if you're looking for that, best to lock in rates when you can as you're ready to go, especially if you're in a 30-day window right now. So, remember that. Call me for contracting if you have any questions or for more information. Here's some simple disclosures. Then we'll go ahead and end that presentation. And what I'm going to do, though, is pull up the 1 year so you can see what's kind of going on. And I'll have links in the descriptions to where you can find these cool, track the 1 year. But as you can see, the 1 year drop here, boom, there it is. It was really quick. It went from the 490 all the way down to 4.3. We're hovering about 4.34 right now. So that's quite a drop. As you can see, it looked like it went off a cliff right there. So yeah, that's CNBC. If you want that, I'll have a link in the description. And the Treasury has a place where you can go back and you can look at a historical view of all the Treasury rates, and you can click by month, or you can go back to any year you want to look at there. And again, I'll have a link in the description to all that. So anyway, thanks for watching. Yeah, we don't know what rates are going to do right now, but hopefully we'll see another increase. But as of right now, I'd be more leaning towards a decrease, especially in those shorter term rates, since those 1-year treasuries and 5-year treasuries have really reduced quickly. So the insurance companies will probably react. So anyway, thanks for watching. Hope you're all having a good week. Talk to you soon. Bye-bye.